Welcome in second lecture, Financial Management. Today we will explain understanding financial statements, taxes, and cash flow. Main learning objectives in this lecture: we will describe the four basic financial statements and discusses importance of financial statements. Then evaluate the profitability using the income statement and estimate firm tax liability. Main principle when we prepare financial statement. Principle 1. Money has time value. That means we need to recognize that financial statement to no adjust for time value of money. When we prepare financial statements, we don't look to value of money, to market value, because we prepare financial statement according to historical cost. Principle 2. Cash flow are source of value. That means financial statements provide an important starting point in determining the firm cash flow. We should distinguish between the cash and the profit. Maybe the company achieve high profit and same time no cash, because maybe all sales on credit. For that, we should be able to distinguish between reported earning and cash flow. It's possible for a firm to report positive earning, high profit, but no have cash. Principle 3. Market prices reflect information. The importance of financial statements reflect to investors, to shareholders, to make his investment decision. For that, firm financial statements provide important information that used by investors in forming expectation about the firm. Example, when the company announces financial statements and announce there are profits, there are good performance, that will reflect on shareholders to make their decisions to expand in the investment in the company, or if the company has down in the profit, maybe reduce the investment or cancel the investment in the company by sell the shares. For that, the information of financial investment very important. An overview of firm financial statements. Basic financial statements. There are four main financial statements reports: balance sheet, income statement, cash flow statement, and statement of shareholders' equity. Basic financial statements. When we prepare financial statements, there are many principles. Prepare financial statement according general accounting accepted principles. When we prepare income statements provide the following information for a specific period of time. For example, a year, 6 months, 3 months. Income statements include revenue from sales of goods, revenue from introduce the services, and also include expenses. Example, advertising expenses, administrative expenses, marketing expenses, expenses associated with the operating activities for the company. The differences between the revenue and the expenses will be loss or profit. For that, main elements in income statements, revenue, expenses, and profit. Balance sheet. Balance sheet provides a snapshot of the following on a specific period. For example, as of 31 December for 1 year, we can to prepare balance sheet, or we can to prepare balance sheet for 6 months. Balance sheet includes assets, liabilities, and shareholders' equity. Assets mean value of what the firm owns. Example, lands, equipment. The assets divided to two types: current assets and fixed assets. Liability. Liabilities value of firm debts, and dividend to also two types: short-time liabilities and long-time liabilities. And shareholders' equity. Shareholders' equity, the money invested by company owners, by shareholders. Cash flow statement. Cash flow statements, it reports cash received and cash used. Cash flow represent for the company the cash used and spent by the firm for over time period, over the last 6 months, but usually we prepare cash flow for 1 year. Statement of shareholders' equity. It provides a detailed account of the firm's activities in the following account over period of time. Shareholders' equity include common stock, preferred stock, retained earning account, and change to owner equity. What's different between common stock account and preferred stock? Preferred stock has more advantage than common stock. Example, constant dividends. Now, there are 4 financial statements: income statements, balance sheet, cash flow statements, and statements of shareholders' equity. What is focus of this chapter? This chapter we will focus on 3 statements: balance sheet, income statement, and cash flow statement. So, why study financial statement? We are studying financial statements for help us to evaluate the performance of the company and evaluate the position of the company. Also, to make control on activities, to make control on the position of the company. And financial statements help us to make forecasting in the future. Example, if we have income statements include in 2010 $1 million and next year $2 million. That's mean they are improving in sales of the company. For that, financial statements help us to make forecasting in the future. What are accounting principles used to prepare financial statements? There are three main principles using to prepare financial statements: the revenue recognition principle, the matching principle, and the historical cost principle. The first principle, the revenue recognition principle, it states that the revenue should be included in the firm income statement for period in which its goods and services were exchanged for cash. Example, when we sell the cash, we will receive the money. The firm has completed what must do be entitled to cash. Second principle, the matching principle. This principle determines whether specific costs or expenses can be attributed to these periods' revenue. Example, when we pay salary, recognized when the product produced as a result of the work is sold, and not when the salary are paid. Third principle, the historical cost principle. When we prepare financial statements, depend on historical cost, not according to market value. For that, we will not adjust the number when we prepare financial statements. For that, most assets and liabilities are reported in the firm financial statements according to historical cost. The historical cost generally cost not equal the current market value of assets or liability. Example, if we have lands recorded in $1 million, but market value for this land $2 million, we will not make adjust for this value of lands because we depended on historical cost. But in generally, historical cost not equal market value, maybe less than or higher than. Now, how we can to prepare income statements? What main elements income statements? And what's importance income statements? An income statements called as loss and profit or profit and loss statement. Income statements measure the performance for the company for over time period, 6 months, 1 year. We can to evaluate the performance of the company, evaluate the main activities for the company, sales, inventories, account receivable, by evaluated the performance for the company. Income statements can be expressed as revenue minus expenses equal the profit. Main equation or main expressed for income statements, revenue minus expenses equal the profits. Now, income statements includes revenue from sales of goods, revenue from introduce the services, expenses. Expenses include cost of goods sold, interest expenses, selling general administration expenses, depreciation, and income tax expenses, and any expenses associated with main operating activities for the company. Now, the differences between the revenue and expenses will be loss or profit. The profits include gross profit, net operating income, also known as earning before interest and tax, and earning before tax. After that, we will arrive to net income for the company. Now, income statements as details includes sales. We will start when we prepared financial statements. The first we will be sales. After that, we will minus cost of goods sold. The result will be gross profit. Example, if we bought car by $1 million, after that we sold it by $1,200,000. Now, the sales will be $1,200,000, and cost of a profit, cost of goods sold will be $1 million. The differences between the sales and cost of goods sold will be gross profit. After that, we will minus operating expenses. Operating expenses includes selling expenses, general and administrative expenses, depreciation and amortization expenses, total operating expenses. Now, after gross profit, we will minus total of operating expenses for arrive to net operating income. Net operating income, net with associated with main activities for the company. After that, we will minus interest expense. Interest expense not associated with the operating expenses. For that, we will minus interest expenses alone for arrive earning before tax. After that, we will minus income taxes. The result will be net income after the tax. Simple income statements for how we can to prepare financial statements. This is example HG Company income statements ended 31 December 2010. We started with the sales. After that, we minus cost of goods sold for arrive to gross profit. After that, we will minus operating expenses, selling expenses, general and administrative expenses, depreciation and amortization expenses, total operating expenses. Now, when we minus gross profit from total operating expenses, we will arrive to net operating income. After that, we will minus interest expenses to arrive to earning before taxes. After that, we will calculate taxes percent for arrive net income. In these statements, there are additional information. Now, income statements help us to evaluate the performance, help the investors, help the shareholders to make his decision. But there are some information as additional informations. That additional information help the investors to make his decision. Additional information include dividend paid to stockholders during 2010, number of common share outstanding for arrive to earning per share, and dividend per share. Main idea in additional information to know earning per share and dividend per share. How we can to calculate earning per share and how we can to calculate dividend per share. We can use the income statement to determine the earning per share, EPS, and dividends. Earning per share equal net income, dividend, number of shares outstanding. Earning per share equal net income, dividends, number of shares outstanding. Example, a firm reports a net income $90 million and has 35 million share outstanding. What will be earning per share? What earning for one share? Earning per share equal net income, dividend, number of shares outstanding. In this example, net income 90 million, number of shares 35 million. Now, when we dividend 90 million on 35, the result 2.57. 2.57. What's the meaning? 2.57 for per share. That's mean one share achieved earning 2.57 for one share. Dividends. We can determine the dividends paid by the first to each shareholders by dividend the total amount of dividends and reported on the income statements. Dividend per share equal net income, dividend, number of shares. Example, a firm reports dividend payment of 20 million on its income statements. Dividend payment will be appear in income statements as $20 million and has 35 million share outstanding. What will be the dividend per share? Dividend per share equal net income, dividend, number of shares outstanding. In this example, net income $20 million and number of share outstanding $35 million equal $0.57 for per share. That's mean earning per share for one share in the example 2.57 but the dividend for per share 0.57. That's mean there are dividends policies for the company. The company didn't pay all the dividends, all net income. For that, what can the firm do with net income? The first, pay dividends to shareholders, but not 100, maybe 70%, maybe 60%. This depends on dividends policy. And reinvest in the firm. Reinvest in the firm depend on the cash position and net income. Example, if the liquidity position is good for the company and there are good projects, good alternative projects, maybe we can to invest, we can to expand in the investments. But if there are no good alternative projects, we can to pay dividends for the company. In the last example, the company achieved $90 million as net income, while the dividends was $20 million. That means there is $70 million. That's the firm balance or retained earning will increase by $70 million. We will appear in balance sheet. Now, $70 million, the company, we will reinvest this amount, or maybe to be as cash. That's depend on the alternative chances for the company. Now, a question, we will solve a question about how we can to prepare income statement. The question, prepare income statement for the X company for the year ending 31 December and given the information as advertising expenditure, beginning inventory, depreciation, ending inventory, cross sales, interest expenses, lease payment, management salaries, materials purchase, research and development, repair and maintenance costs, retained and allowances, and taxes. How we can to prepare income statements according to this information? Now, the first step when we prepare financial statements, income statements, we will start in the sales. In this example, the sales, gross sales $3,210. After that, we will minus retained and allowances, $48,000. The result, net sales will be $3,162. After that, we will minus cost of goods sold. How we can to calculate cost of goods sold? Cost of goods sold include beginning inventory, $256, plus material purchase, $2,425, minus ending inventory, $248. The result will be cost of goods sold. After that, we will minus net sales from cost of goods sold. The result will be gross profit. After that, we will minus operating expenses. We will calculate all operating expenses, management salaries, and research and development. After that, we will arrive to operating profit. The operating profit, $234. After that, we will minus interest expenses. Interest expenses in this example, $64,000. The result will be earning before taxes. The taxes in this example, $51,000. Now, when we minus earning before taxes, from taxes, we will arrive to net income, in this example, $119,000. The main idea in when we prepared income statements, to start in sales. After that, we will minus cost of goods sold to arrive to gross profit. After that, we will minus operating expenses to arrive to net income. Now, in this lecture, we explained how we can to prepare financial statements. We focus on income statements. In next lecture, we will explain how we can to prepare cash flow and balance sheet. Thank you for your attention and see you in next lecture.